welcome. And to those who came back for more real-world practical investing advice for free, welcome back. My name is Daniel Leitner, and I'm a financial advisor here with Hendricks Wealth and Estate Management, and I will be the one guiding us today on our journey of finding out what really drives long-term investment success. The other members of the Hendricks team that will be assisting me on our journey today are Jim Madel, Tom Anderson, and Sean Hendricks. All right, today's session is meant to be educational. We're going to talk about what actually drives long-term investment success and why it is not all about picking the right stock or predicting the market. This is especially important because many people are doing the right things. They are saving, investing, contributing to retirement, but still feel uncertain or anxious. My goal today is to simplify this and give you clarity. Most investors believe success comes from finding the right stock, the right fund, or the right time to invest. And then financial media reinforces this constantly with hot tips, market predictions, and headlines designed to grab your attention. My guess is many of you, just like me, get those headline article ads like, "This stock is the next NVIDIA," or "If you wished you bought Apple in the 80s, this stock is your opportunity to not miss the wave again," or something along those lines. Now, of course, picking that next Apple or NVIDIA type stock helps when it comes to securing your financial future. But that is not the only way to control your financial destiny. In fact, there are decades of data showing that stock picking and market timing explain very little of long-term results. Focusing on picking the next big stock and trying to time the market perfectly often hurts outcomes more than it helps. If you remember one slide from today, make it this one. The 4 factors listed on this slide explain the vast majority of long-term investment success. None of them require predicting the future, none of them involve speculation, and none of them include access to privileged information. But all of them, and this is critical, are within your control. The 4 main drivers of long-term successful investing are time in the market, asset allocation, costs and taxes, and emotional control. Or said another way, investor behavior. This aligns closely with what Dave Ramsey has taught for years. Wealth isn't built by doing fancy things. It's built by doing simple things consistently for a long time. So diving deeper into our first driver, it's all about time in the market and investing consistently. Let me give you a couple quick examples to help you digest this point. Since it is March and the madness is already underway, why not use a basketball example? So, picture this. The game is on the line. Your bracket hangs in the balance. Will your Cinderella prevail against that SEC powerhouse team that your annoying brother-in-law went to? In that situation, would you rather trust a player at the free throw line with only a couple hours of free throw practice under his belt? Or would you rather trust the player who has stayed after practice constantly, gotten up early in the morning, and made sure to dedicate time every day to shooting free throws? Time and consistency matter. Another way of looking at this is, would you rather trust the airline pilot with 10 hours of experience with a runway wipeout or two, or the seasoned veteran pilot with a decade of piloting experience with a flawless record? Time and consistency matters, right? Compounding doesn't care about the headlines. It rewards that very same time and consistency. Someone who invests steadily over 30 years, even through recessions, almost always ends up ahead of someone who jumps in and out of the market trying to avoid downturns. This is why we emphasize starting to invest early, continuing to regularly, and staying invested, even when it feels uncomfortable. Staying invested and continuing to invest when it feels the most uncomfortable is usually where the biggest gain is. Asset allocation. At its base level, simply means how your money is divided between stocks, bonds, and other assets. For example, someone who is, say, 25, investing for retirement should probably be invested more aggressively than the 85-year-old who is already retired. Said another way, the 25-year-old should likely have a greater percentage of his investments in higher risk, higher reward assets like stocks, and the 85-year-old should likely have a greater percentage of his investments in typically safer and more stable assets like bonds. Now, that is not to say the 85-year-old can't own stocks or that the 25-year-old can't own bonds. And it is true to say that knowing the right mix can be complicated for one person to figure out all on their own. That is why having a licensed professional in your corner who helps guide other people through that same question on a day in, day out basis can be so crucial to your long-term financial success. All right, I'll get off my soapbox. All that to say, a well-diversified portfolio doesn't have to try to be exciting on its surface. What it is really trying to do is be resilient, aligning with your goals, risk tolerance, and time horizon. At Hendricks, we avoid speculation. We don't need to chase returns. What we do need and work to create is a plan that can survive good markets and bad ones. Driver number 3 is investment costs and taxes. Investment costs and taxes quietly compound, just like returns, but in the opposite direction. High fees, unnecessary trading, and poor tax planning can significantly reduce long-term results without ever showing up as a single bad decision. One of our roles at Hendricks Wealth is helping clients keep more of what they earn by being intentional and efficient, not complex. A great question to ask any financial advisor is how they make their money. Is it through an assets under management fee? If so, how much is that fee? Is it through selling clients commission-based products? Do they charge hourly or flat fees for creating a financial plan? Getting upfront answers to those questions can help you understand where your money is going and if it is worth working with that person for you. Another thing we like to say at Hendricks is we are tax conscious, not tax driven. It is all about your tax rate today versus what your tax rate is tomorrow. For example, do you think you'll have a higher tax rate today or in retirement? If you think you'll have a higher tax rate today, it probably makes more sense for you to contribute to an IRA versus a Roth IRA. Another example is, let's say you're 35, inherit an IRA, and are set on climbing the corporate ladder at your job. It might make more sense to take distributions from that inherited IRA at the lower tax bracket you are currently in than the one you will be in 10 years when you get that big promotion. That is just another quick example, but being intentional and having a plan can help you avoid paying higher costs and taxes that truly compound over time. All right, now, believe it or not, the biggest threat to most portfolios isn't the market, it's the individual investor. Panic selling, chasing performance, and abandoning a plan during downturns are the most common reasons people underperform with their own investments. Now, I'm not saying every individual investor does that, but when the market turns and things get rough, it can be easy to abandon your plan if it is not built on solid ground that you know was prepared for this very moment. A way to think about a market downturn that might make it a little more bearable and understandable is to think of a market downturn as being in your favorite store and everything going on at 10, 20, or even 30% sale. If you were in your favorite store, wouldn't you want to buy more stuff when everything is on sale? You wouldn't want to take the shirts you bought last year and try to sell them on Facebook Marketplace when you know the retailer has their own big sale going on. But that is what the typical individual investor does in the market. Instead of buying low when everything is on sale, they abandon ship and sell their holding, realizing true losses. It can be seen as a double mistake. One being not holding on to existing investments, and the second one being not buying more when everything goes on sale. That is where having a disciplined financial advisor can help you ride out the storm and say, we are not abandoning ship. This is the most important time to stay the course. And if you have any extra laying around, it's a pretty attractive time to throw another paddle in the water to steer the ship. All right, I know that was a lot, but let's move on to stock picking. Some people like stock picking because it gives them a feeling of control and ownership. It feels proactive. It gives them that sense of, hey, I did something today. I made a bet, and let's see if it pays off. Now, there are a certain percentage of individuals out there who are great stock pickers. I would say that there are not many, but they do exist. But let me tell you, they are not perfect. Even professional stock picker managers struggle to outperform the market over long periods. The Ramsey philosophy reminds us, building wealth isn't about being clever. It's about being faithful to a plan. A strong investment plan is not built around predictions necessarily. It's built around things like clear goals, like what is your lifestyle today and how much money do you need to have saved up in order to live that same lifestyle in retirement. A long time horizon helps. The more you can leave your money in the market, the more time you have given it to let it grow. Proper diversification means you don't want all your eggs in one basket. It can be very risky to have all your investments tied up into just a couple stocks. It can be okay if the stocks keep going up, but when they go down, things can get messy. And lastly, making sure you maintain ongoing discipline. That means continuing to invest in the markets, whether they are going up or down. Setting aside a certain dollar amount out of every paycheck that you are going to invest and continuing to do it. And most importantly, to stay the course when the market inevitably turns. All in all, it's most important to control what you can. Just like with anything else, you can't control the markets. You can't control what new law is going to get passed or what new market your favorite company is going to target. But what you can control are the things we have talked about throughout this presentation, like staying disciplined, especially when you don't want to, staying diversified, not trying to hit home runs. You can still score when you get on base. Staying consistent, stay the course, follow the plan. Know that you built your financial future on solid ground, and be prepared for the big bad wolf of recessions to try to blow your savings egg out of its nest, because he most certainly will from time to time. And ignore the noise. There is always going to be someone preaching that they have found the next best thing, that they have lightning in a bottle. Then there are doomsday preppers saying that the crash is near and to prepare, sell everything. And they are right from time to time. The market does and will crash. But they also say the market will crash on plenty of up years, just like last year. At the end of the day, we don't have a crystal ball here, and we don't know which way the market will go on any given day, month, quarter, or even year. But what we do know is how to prepare you for both the ups and downs by making sure you are positioned to be ready for both based on your goals, risk tolerance, and personal situation. All right, I'm about to get back on my soapbox here briefly. If you are not happy with where your plan is today after listening to this presentation, please know there is help available. It can be extremely challenging to navigate a full-time job, a family, your investments, and whatever else you have going on all together all at once. We at Hendricks do truly care and are happy, willing, and able to help no matter what your situation. We like to say, spend an hour with us on your finances. It will be the best hour you ever spent on them. We are here to help. You just have to be willing to ask. All right, I'm back off the soapbox. Thank you for your time today. That concludes the presentation part of this webinar. At this time, I am happy to field any questions anyone in the audience has.
That was excellent, Dan. Thank you. And really quickly, while we're waiting to see if we have any questions come in, thanks again for joining us for these weekly lunchtime webinars that we're conducting. Just to let you know that next week on the 25th, we'll have Tom Anderson speaking about legacy giving and leaving your mark. The following week on April Fool's Day, we will have Jim Hendricks joined with a special guest speaker, Joshua O'Brien, talking about Medicare 101. So if you need any insight into Medicare, be sure to join us on April 1st. The following week on April 8th, I will be speaking about the psychology of the spend down and how to successfully transition from being a saver your whole life into being a confident spender. And then the week after that, on April 15th, Sean Hendricks will be speaking about 10 budget killers to avoid. So that is our upcoming schedule. You can always find those at hendrickswealth.com/events. And I'll turn it back over to Dan.
All right, thank you, Jim. We got some good topics in the pipeline. I will say, well, once again, thank you all for tuning in today. Whether you were watching live or you are watching this video as a playback, we look forward to hopefully hearing from you soon and seeing you at one of our future events. Have a great day.
Take care, everyone.